Alrighty, so the economy is in serious trouble. According to the Wall Street Journal, U.S. stocks and bond yields fell, with the S&P 500 flirting with a bear market and a continuing sell-off driven by investor fears that the economy could be pitched into a recession. The major indices dipped early in Thursday's session, a day after tumbling 4% before recovering ground. They ultimately finished lower, with all three on track for weekly losses of at least 2.9%. Concerns about consumer spending, which helped lift the market out of the pandemic lows, have weighed on stocks and bond yields as well. Bond yields tend to go down when people actually invest in bonds. People are rushing to bonds at this point as sort of a safe haven for investment, given the fact that there really is no great place to put your cash at this point. The NASDAQ Composite Index entered bear market territory early this year. It retreated 29.66 points, or 0.3%. Investors are buying government bonds perceived as a haven asset. The yield on the 10-year Treasury notes fell to 2.854% from 2.884% on Wednesday, losing ground for 7 of the past 9 trading days. As I say, bond yields and prices tend to move in opposite directions. In economic news, the Labor Department says new applications for unemployment benefits rose for the third week in a row. Initial jobless claims, a proxy for layoffs, remain historically low. Separately, U.S. home prices reached a high in April, according to fresh data, but the number of sales is falling. So it looks as though we're about to experience a real problem in the real estate markets as well, which isn't a great shock. Again, the prices are so high in every other area of American life that you just don't have enough money left over to pay for the inflated real estate prices that we are seeing right now. Meanwhile, apparently, we are now on the verge of another subprime mortgage crisis. According to the Wall Street Journal, consumers with low credit scores are falling behind on payments for car loans, personal loans, and credit cards, a sign that the healthiest consumer lending environment on record in the U.S. is coming to an end. Who could have predicted that when you make credit extraordinarily loose, that when you give a bunch of people who can't pay back their mortgages, in the hopes that the market will continue to boost prices beyond what the mortgage is actually worth, and therefore the mortgages won't flip upside down. Who could have predicted that this sort of thing would have happened? I mean, it's not like this just happened in 2007, 2008, well within living memory of all human adults. We're going to do the same thing again. The share of subprime credit cards and personal loans that are at least 60 days late is rising faster than normal, according to credit reporting from Equifax. In March, those delinquencies rose month over month for the 8th time in a row, nearing their pre-pandemic levels. Rising delinquencies were inevitable following their decline during the pandemic, many lenders and analysts said. Even so, the increase is getting attention from investors, partly because the Federal Reserve is about to jack up the interest rates, which means you're going to see a lot more people defaulting on their mortgages, and that means that the prices of real estate are going to go down, which is going to flip even more people upside down on the mortgages that they have. So you could be watching the bursting of a real estate bubble here as well. Delinquencies on subprime car loans and leases hit an all-time high in February based on Equifax's tracking that goes all the way back to 2007. Many people, including those with less than perfect credit, paid off debts, built up savings during the pandemic. The government's response, including stimulus payments and child tax credits, boosted financial health. But now, many of those benefits have run out. Subprime borrowers, who sometimes have lower incomes or less savings, are being hit hard. Inflation is also forcing many households to choose between paying for essentials and paying those monthly loans. Wells Fargo Chief Executive Charlie Scharf said Tuesday higher prices for food and gas will constrain U.S. households. He said, we're still in the best credit environment we've ever seen in our lives. There will be deterioration in people's ability to pay. So we could be looking at the beginning of a serious problem in the mortgage market as well. How bad are things getting? Well, people are now finally unretiring. Well, one of the stupidities of the American job market is that we assume that people are going to retire and should retire at the age of 65. Okay, when we made the national retirement age 65, when Social Security benefits kicked in at the age of 65, the average life expectancy in the United States was 63, which meant that you were really old. 65 was old at the time. Well, now 65 is actually really, really young. You can expect, if you're born today, you can expect that you will live to at least 80 years of age. And that means 15 years in which you ain't getting paid to do a job. And for the vast majority of people, I mean, right now, the president of the United States is 80 years old. Right? I mean, by this logic, he should have retired 25 full years ago, if you're talking about 55 years old. Okay, the reality is that 65 is the new 55 and 55 is the new 45, which makes sense since we treat adults like children in this country. But instead, we have basically said to 65-year-olds, no, you have to be forced out of the job market. Well, now, because it turns out that inflation eats away at fixed incomes, things like Social Security, what that means is that people are going back into the job market after all, which maybe is a good thing, but it's not a good thing for the people who have to do it. According to the New York Times, when Kim Williams and millions of other older Americans lost their jobs early in the COVID pandemic, economists wondered how many would ever work again. Miss Williams, now 62, wondered too, especially when she struggled for months to find work. But in January, she started a new job at a AAA near her home in Waterbury, Connecticut. I'm too young to retire, so I had to go back, she said. Whether by choice or financial necessity, millions of older Americans have made the same move in recent months. Nearly 64% of adults between the age of 55 and 64 were working in April, essentially the same rate as in February 2020. That's a more complete recovery than among most younger age groups. So the older people being smarter than the younger people are like, maybe I should go back to work. Meanwhile, you have people in other age brackets really lagging in terms of where they were as far as labor force participation rate. So, for example, if you take the group 20 to 24, that group is still lagging about 5% below where it was before the pandemic in terms of labor force participation. A bunch of people are basically just sitting out the economy right now thinking everybody's going to continue paying their bills. Those are the people who are going to come up short when it comes time to pay for their mortgage or when it comes time to pay for that car. Those are the people who are going to be defaulting. The rapid rebound has surprised many economists who thought fear of the virus would contribute to a wave of early retirements, but there's increasing evidence that early retirement narratives were overblown. The bottom line is that older workers have gone back to work, said Alicia Manel, director of the Center for Retirement Research at Boston College. So maybe that's good in terms of bringing down the wages, because if you have a broader supply of labor, this does bring down the wages. But again, for a lot of people who are on fixed income, inflation is eating away at everything, and they are suffering and they are feeling it, which is, of course, why there's a new CNN poll showing that 86% of people are at least somewhat scared of how things are going in the United States. Here was CNN reporting that yesterday.
65% of Americans in our brand new CNN poll tonight say they are concerned about how things are going in the U.S. Only 4% excited, 10% optimistic. Even 1 in 5 say that they are scared.
Okay, so those are really, really bad numbers. I mean, those are terrible numbers. You're talking about excited or optimistic 14% of Americans. And going into a midterm election cycle for Democrats, that's really, really bad. It's particularly bad because we are now no longer just in an inflationary cycle. So the Biden administration, they kept saying, you know what? Inflation is really, you're looking at the wrong side of the coin. Inflation, the other side of that coin is heavy consumer demand. And heavy consumer demand means people are doing great because after all, they're out there buying things. And if you're buying things because you have the money to buy things. And this means things are going swimmingly. Well, if you have a hot economy and inflation working in tandem, then it's not great, but it's not the end of the world. When you have stagflation, now you start to look at the end of the world. When you have economic stagnation and inflation, the prices are prices people cannot pay, and also nobody's buying anything. That's like the worst of all possible worlds. This is what happened during the Carter administration and the first couple of years of the Reagan administration before Paul Volcker jacked up the interest rates to like 20%. So Mohamed El-Erian, who is the head of Allianz and who is an excellent economic commentator, we've had him on the program before. He really knows his stuff. He's written very critically of how basically every major government in the world has delegated all financial responsibility to their central banks. They basically told their central banks, you're in charge of unemployment and you're in charge of the inflation rate. And they've given them too much to do. They've used them as the solution of first resort as opposed to the solution of last resort. And that means when things get ugly, there's not all that much that central banks can do. And central banks aren't always right. They mess up a lot. Mohamed El-Erian, he said yesterday, well, stagflation, it's unavoidable. He used the word unavoidable. It's now coming. We have inflation, and now we're going to get economic stagnation. That is like the worst possible scenario for America. It's the worst possible scenario for the party in charge of the country right now.
What is unavoidable is stagflation. And we're seeing growth coming down, and we're seeing inflation remaining high. And the Fed is finally catching up to developments on the ground, but it still has some way to go.
And Mohamed El-Erian, very, very critical of the Fed's response in all of this, basically saying they overshot the mark and they've been slow off the ball every single time. Remember, Jerome Powell originally said inflation was going to be transitory. Then he was like, well, no, maybe it's not so transitory. Then it was, there will definitely not be a recession. Then as well, it's going to be kind of hard to avoid a recession. Maybe he's just really bad at his job. According to many, many investment fund managers, like 77% of them, they see an economic storm of slowing growth and high inflation taking hold over the course of the next year, according to Yahoo Finance and Fortune magazine. Top economists and money managers worldwide are warning that rising consumer prices and falling economic growth are combining to form a deadly recipe for the global economy, stagflation. Some 77% of investment fund managers say they see below-trend growth and above-trend inflation. That would be stagflation as the most likely outcome for the global economy over the next year, according to a May survey from the Bank of America Global Research. That is the highest percentage seen since August of 2008, when the economy was pretty terrible. Still, despite these gloomy predictions about stagflation, most of the fund managers say that they believe we are past the worst spike in inflation, but being past the worst spike in inflation doesn't mean that inflation is going to be in good shape anytime soon. Last month, the inflation rate was 8.3%. The month before that, it was 8.5% on an annualized basis. That just means that it's going up slower than it was. It doesn't mean that everything is going back to something resembling normal. And for all the investors out there, the question is, where do you put your money? I mean, really, where do you put your money? Bitcoin has taken it on the chin. The dollar seems to be maybe the best bet at this point, simply because they're raising the interest rates. So people are buying into bonds and securities. They're moving out of the stock market. There's talk of a possible 10-year slowdown in stock market growth. All of this is horrible news. And it's bad news generated by bipartisan spending policies and an idiotic assessment by the Biden administration that the way that you get out of an inflationary spiral is apparently to punish businesses. That the best way that you can actually get out of an inflationary spiral is to deliberately seek stagnation. This is crazy. If you're going to get out of an inflationary spiral, what you have to do is jack up the interest rates, but free businesses at the same time, because that leads them to believe that their economic fundamentals are still sound. That if they do things right, if they run a tight ship, they will still not only survive, but thrive and get to keep the benefits of their own labors. But if you have an inflationary cycle combined with a bunch of bad regulation and high taxation, who in their right mind is going to invest into that market? Who? And yet this is exactly what the Biden administration is openly pursuing at this point. So, for example, you have the National Economic Council director for the Biden administration openly saying that they want to raise taxes to cut inflation. So your solution is that you're going to disincentivize businesses from investing? This is your plan? That's actively seeking stagflation, because here's the thing. Raising taxes is not going to markedly bring down inflation. The inflation rates are going to be markedly brought down by the increase in interest rates from the Federal Reserve. At the margins, you might see a minor decrease in inflation thanks to raising the taxation on corporations simply because they won't be able to afford to pay their workers, and so the wages are going to go down a little bit. So it'll have a little bit of a marginal effect on the wage price spiral, right? Because if wages go down, prices will have to go down in order to meet the dropping wages. But how is that? So your plan to get out of this is to make the American worker feel the pain of losing their job via you going after their boss? I guess, I sort of understand the logic if you're the Democrats, because if you're the Democrats, I guess the idea is somebody's going to have to be the bad guy here. Let's make it your employer. It can either be us or it can be your employer. Now, a normal sort of honest economic take here would be, it's us, right? We're going to have to raise the inflation rate. We blew it. Inflation rate going up. We're going to get this sucker ironed out, and then it'll all be good. And they still have time to do this. They do. Remember that in 1981, when Paul Volcker began raising the interest rates, by 1982, Ronald Reagan had a pretty bad off-year election. By 1984, the guy was winning 49 states. So it is definitely possible to say to the American public, we're about to go through a rough time. There's something we have to do to get things back looking good again. We have plenty of room to ramp up the interest rates without completely sinking the economy, but you're going to have to bear with us, and there will be some pain. Now, you could do that, but they can't do that because Joe Biden and the Democrats have a pathological aversion to taking blame for anything they themselves do. So instead, what they plan to do is raise taxes, punish corporations, force the corporations to fire people, and that will somehow, in a backdoor fashion, bring down wages, which will eventually bring down prices. That's pretty gross. It really is. So here is the head of the National Economic Council, Brian Deese, talking about how the raising taxes is going to somehow solve this problem.
If we can continue that deficit reduction, then we will continue from a fiscal policy perspective to reduce price pressures in the economy. And one of the most sensible ways to reduce the deficit right now is to enact corporate tax reform that would level the playing field, that would reduce the incentives for corporations to drive profits and production overseas, and would increase revenue to the federal government.
So they keep going over and over to this idea. First of all, even the outcome of his own policies don't make sense. He's talking about how basically corporations are just being greedy and that's what's driving inflation. That's not true. That is not true. Did corporations suddenly become radically greedy? According to Democrats, they've been greedy the whole time. So what magically changed that made them greedy all of a sudden? Also, when he says at the very end of that clip that this is going to drive more revenues to the government, revenues to the federal government are at an all-time high right now. That is not the problem. We are taking in more money at the federal government level than any time in American history right now. Bar none, not close. That is not the problem. The problem is whatever we take in terms of the federal government, we then blow out twice as much. That's the problem. The spending side is the problem. But they refuse to see that because, of course, it cuts directly against all of their economic preferences. So who else are they going to blame? They're blaming corporations. They're also, of course, going to blame Vladimir Putin. Here's Brian Deese again.
I think the price increases that we've seen in energy markets, we know why that is happening, and it's because Putin invaded Ukraine. The war has taken Russian supply of product, but also Russian refinery capacity off of the market, and that has put upward pressure on price. Okay,
so again, this is the way that they're going to get out of this, just blaming other people. It isn't going to work. If Americans are disquieted about the economy and your plans are let us raise taxes and yell at corporations and talk about Vladimir Putin, that is not going to do it. It's also not going to do it when you have no solutions to any of the problems that your own FDA created. When all of your regulatory agencies that work for you are so bad at their job that you end up with a serious baby formula shortage. And then you've got the White House legit telling people that the solution to this problem is to call your doctor to get free samples of baby formula, when all of this could have been handled. Right? If you're going to use the FDA to shut down domestic production of this sort of stuff, at the very least, you need to relieve a lot of the regulations on bringing in foreign supply of baby formula. But they didn't do that. So instead, the White House has now put out a tweet. It says, guidance to follow if you're having trouble finding infant formula. Don't water down formula or try to make formula at home. Instead, call your OBGYN or pediatrician to see if they have in-office samples. So, great. That is what we have now been relegated to. I wonder why people are feeling really, really uncomfortable with the way this administration is addressing economic problems. The good news is that we have deployed the President of the United States, Joe Biden, to Central and South America to talk about the United States economy. I call her the President of the United States because Joe Biden clearly is not. We may have an Edith Wilson situation on our hands where basically Woodrow became a meat puppet and Edith was standing behind him moving his face like, and like weird sounds would come out and Edith would just basically define the policy. We may be almost there with Joe Biden and Joe Biden at this point. So Joe Biden was talking about how the real problem in America is income inequality and inequity. And she was saying this is what matters to people in Ecuador. I'm sorry, could you be any more disconnected from the American people at this point? Like, or the people of Ecuador, by the way. Are the people in Ecuador like, man, that income inequality in the United States really sucks? Or is everyone in Ecuador trying to get into the United States to like start at the bottom rung of the ladder? Like, what in the world? Here's the greatest doctor in America outside, of course, of Dr. J. Here's Dr. Joe Biden.
What does inequality in the United States matter to young people right here in Quito? But they do matter. Injustice and corruption, poverty and pollution, disease and despair, they aren't contained by any borders. If we learned anything from the COVID-19 pandemic, from these last few years of sickness and sorrow, it's how one deadly virus can move through the world.
What? Just like what? And also what? If we learned something from COVID, what we actually learned is that all of our elites are morons telling you that they can control your life top down and wreck everything. We were told that they were all the experts and they were going to fix everything. And it turns out that they blew up the economy. It turns out that 1 million Americans still died. It turned out that they masked up your kids for no apparent reason and kept them out of school for no apparent reason and destroyed your business for no apparent reason. So yeah, I think that's mostly what we learned. But according to the Biden administration, no, what we actually learned is how good they are at these things and that they should have more control. How's this for a title? Ben Shapiro Show subscriber destroys like button with clicks and logic. I'd watch that. Make it happen, gang.